Welcome back to Investing Talk Podcast.
Today we're looking at Intercontinental Exchange.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We've synthesized recent financial reports, analyst consensus, and technical trading data to give you the most comprehensive view of this critical financial infrastructure provider.
Right.
Our focus today is to figure out if IC's foundational strength, really translates into continued market outperformance, or if its valuation has just run a bit ahead of itself.
Yeah, that's a great way to frame it, because when you look at the Q3 2025 results, the numbers, they're pretty eye-catching.
They are.
We're not talking about small gains here.
Yeah.
This is some serious earnings momentum. Net revenues hit, $2.4 billion? That's a solid 3% increase year over year.
Yeah, but the real story is that operational leverage, that top-line growth, the 3%. It's fine.
Yeah.
You have to look down the income statement. GAAP diluted earnings per share shot up a remarkable 25% to $1.42.
Wow.
And the adjusted EPS, it matched that, also up 25% to $1.71. That kind of acceleration, where earnings grow 8 times faster than revenue, that tells you this is a highly efficient, very scalable business model.
Absolutely. It indicates really effective cost management and maybe more importantly, that the company is hitting a kind of inflection point.
Right, where that marginal revenue is almost entirely profit.
Exactly. Because the necessary infrastructure is already paid for. And this isn't, an isolated thing. When you look back at the trailing 12 months, the demand is just, it's overwhelming.
It is. Over the last year, the revenue hit $9.28 billion, up over 16%.
Right.
And net earnings showed the same kind of health, climbing 16.30% to $2.75 billion. It just confirms the growth drivers aren't fleeting, they're structural, and that's why the future outlook is so optimistic.
Okay, so how optimistic are we talking here? What's the street projecting for this kind of momentum?
The consensus is really strong. Analysts are modeling earnings per share growth at a compound annual growth rate of nearly 18% over the next 5 years.
18%?
Yeah. To put that in context, that's a belief that they're going to nearly double their earnings in 5 years. You just don't get that kind of long-term confidence unless the market believes the company owns an irreplaceable position in the financial landscape.
Speaking of that irreplaceable position, let's talk about the financial architecture that supports all this. Growth is great, but stability is everything. So what's the balance sheet telling us?
The financial foundation is, it's exceptional. They are strategically underleveraged, which is pretty rare for a company that relies so heavily on M&A for expansion.
Right.
Their debt-to-equity ratio is just 0.61. This ratio is key because it signals that management has plenty of dry powder.
For what? Acquisitions? Share buyback?
Exactly. For increased distributions, buybacks, or for seizing those large strategic acquisition targets, the kind of targets that really cement their market dominance.
And their ability to generate the cash to do all that is just remarkable. We always talk about free cash flow as the true measure of a company's health.
It's the lifeblood. An ICE is a cash generation machine. A price-to-free cash flow ratio of 20.42 suggests, a really consistent and robust conversion of earnings into hard cash.
And that's what lets them reinvest and reward shareholders.
That's right. It allows them to continuously reinvest, upgrade their tech, and just maintain their competitive edge.
And you see this efficiency reflected in their productivity metrics, right?
Yeah.
The revenue per employee figure is just shy of $750,000. That's an insane amount of revenue for each employee.
It speaks volumes about the digital nature of the business. It's not like manufacturing or retail.
No.
Financial exchanges, leverage technology, and network effects. Once the trading platform or the clearinghouse is built, adding a new client, it costs next to nothing in marginal labor. That high productivity isn't just a metric. It's the fundamental expression of their competitive moat.
Okay, let's unpack that moat, because this is where the analysis really matters. We know they're massive, but how do they lock in their clients and sustain that dominance against powerful rivals?
It really boils down to 3 core areas of dominance: exchange, clearing, and data. They command leading positions in all 3, which creates this, triple layer of defense.
So they're diversified.
Very. If fixed income trading slows, commodities or equities often stay robust.
Oh.
But the real defense is the switching cost.
Switching costs. Okay, so explain for us what makes it so hard for a big bank, for example, to just move its business to a competitor.
Well, it's not just moving a file. It would be regulatory and technological suicide to move quickly. Institutional clients, the huge banks, asset managers, hedge funds, they are deeply integrated into IC's clearing and data system.
Right.
These systems are often proprietary, and they're essential for meeting really stringent regulatory compliance standards. Migrating massive data sets, retraining thousands of employees, and risking operational failure. It means the cost of switching is astronomically higher than any slight price difference a competitor might offer.
So their market share is basically a regulatory and technological lock. They're
Right.
not just processing trades, they are the plumbing of the global financial system.
Precisely. And they are constantly reinforcing this lock through innovation. We noted their focus on high growth trends, sustainable finance, digital assets, ESG data.
Right, they're getting ahead of it.
Exactly. By pioneering data services in these new complex areas, they force clients who want to participate in those markets to integrate even deeper with their platforms. It's a continuous moat-widening exercise.
That makes sense. So as the industry automates and shifts toward, I don't know, climate derivatives or tokenized assets, ICE wants to be the mandatory gateway.
It's a fantastic long-term defensive strategy. They're not chasing trends, they are building the railroads for the new trends.
Okay, so we have incredibly strong fundamentals, a deep moat. Let's pivot now and look at how the market is pricing all this. What's the technical picture telling us?
The technical picture is bullish, but it's showing signs of strategic consolidation, which can create opportunities. The stock has shown a really resilient bullish trend, consistently holding key levels and making higher lows.
And recently?
Recently, it's been trading in a pretty tight range, between about $152 and $154.
So where should investors be looking for confirmation that this uptrend is still intact?
The key support level we're watching closely is around $142. If the stock drops but holds that level, the overall technical uptrend is confirmed.
And on the upside?
On the upside, breaking through the resistance at $158 and then that psychological level of $160 would signal a pretty decisive move toward new highs.
Let's talk about momentum, because the indicators are sending a very specific signal here.
They are, and it's a fascinating, slightly contradictory signal. The relative strength index, the RSI, is currently down at 23.33.
So oversold.
Well, it suggests that momentum has been draining out during this consolidation phase. This could potentially set the stage for a sharp reversal once positive news hits. There's just so much room to run without becoming overextended. And this setup is supported by a confirmed bullish bias in the MCD.
That's a great technical setup, but is the big money backing this idea? Are institutions buying in?
Yeah, institutional accumulation has been ongoing. The whale wisdom data confirms large investor inflows continue to support the valuation. Big institutions clearly believe in the multi-year compounding story. They see any dip as a buying opportunity.
Okay, but institutional conviction doesn't always align with the view from inside the company. And here, we do have a bit of a cautionary note. There are some mixed signals from insider activity.
That's the critical piece of nuance you have to look at. While everyone else seems optimistic about the long term, we have seen some notable insider sales filed in recent quarters. Specifically, a November 20 filing for the proposed sale of over 1,500 common shares acquired through performance units.
That raises a big question. If everything is so strong, why are executives selling their shares?
It's often a sign that those closest to the company feel the near-term valuation might be, a little stretched, or that the growth implied by the current share price might be hard to hit right away. It doesn't signal a crisis, but it definitely suggests some internal caution about the immediate upside.
Okay, so given that mixed sentiment, let's look at the near-term calendar. What events are coming up that could act as catalysts?
We have two very specific dates coming up. First, November 28th is the date for index and ETF rebalancing. This reliably drives up trading volumes as fund managers adjust their portfolios, which translates directly into fee revenue for ICE.
And there's a big balance sheet event in early December.
Yes, December 1st is the maturity date for $600 million in senior debt. What's important here isn't the debt itself, but how they've managed it. They recently did a $1.25 billion notes offering, and they've earmarked the proceeds to pay off that $600 million.
That's a sign of proactive financial management.
Absolutely. It preserves their capacity for strategic M&A without increasing their leverage.
What about shareholder returns? Any catalysts there?
The dividend ex-date on December 16th is one to watch. Given the strong free cash flow and earnings growth, the company typically reviews dividend increases near the end of the year. A nice dividend hike could definitely be a positive catalyst.
Okay, so beyond confirmed dates, what are the rumors circulating?
The speculative buzz is around two areas. First, more M&A in the fintech data services space, which would strengthen their data segment. And second, and this could be more transformative, is the speculative expansion of their offerings in climate risk derivatives.
Climate risk derivatives. That ties directly back to their ESG innovation focus. If they build a dominant platform there, that's a massive emerging market.
It leverages their core competencies perfectly: market structure, regulatory knowledge, and data. If that gets confirmed, the opportunity in climate and sustainability could be a multi-billion-dollar long-term growth driver.
Powerful catalyst. Let's flip to the downside, though. What are the primary risk factors here?
The number one risk is valuation. When a company is this strong, it rarely trades cheaply. We're looking at a price-to-earnings ratio comfortably above 30, and crucially, the PEG ratio, the price to earnings to growth, is at 1.87.
A PEG of 1.87 is definitely not a cheap stock. It tells you the market is already pricing in that 18% growth rate we discussed.
Precisely. There is very little margin for error. If growth were to slow down even slightly, the market multiple would likely compress, and that would cap the upside.
And then there's just broader market risk.
That's right. The beta is 1.09, so it has a moderate sensitivity to the broader market. If the S&P 500 were to correct, ICE would likely follow.
And finally, there's always the threat of regulation and competition.
They're leaders, but the landscape is always shifting. New regulations or new entrants challenging their data monopoly, even on a small scale, they could impact future growth.
So bring this all together, the 25% EPS growth, the impenetrable moat, the technical consolidation, and the high valuation risk. What's the final synthesis for an investor today?
The investment thesis is, I think, overwhelmingly bullish for the long-term compounder. ICE offers exceptional fundamental growth, robust financial health, and a durable competitive advantage. This is a core holding for patient capital.
And for the short term?
Short term, that oversold technical reading combined with the upcoming catalysts, the rebalancing and the dividend review, it creates a trading opportunity. But fundamentally, this is a long-term play on the automation and complexity of the global financial system.
So to wrap up, it sounds like investors should be watching two things.
I think so. First, keep your eyes on how they execute on that rumored expansion into digital and climate asset solutions. That's going to be the deciding factor in how much further they can widen their moat. And second, just monitor the management of that high PEG ratio. Continued outperformance is mandatory to justify the price.